financial argument, follow us on YouTube.
As a cryptocurrency, it is very useful, and with a lot of other cryptocurrencies out in the market, they're all competing to be for market share. And the fact that they're starting to be used, especially Bitcoin, proves that it is a viable technology, and a lot of people have researched it and concluded that yes, it is a viable technology.
I'm Kenneth Amaduri, and today let's talk about the futures and the disconnected price between the physical and paper gold markets. And really, we're going to be talking about how the international gold price is derived and where it comes from. And to cover with us today, we have precious metals expert and analyst Ronan Manley of Bullion Star, a precious metals bullion dealer. And we'll have the links in the description area. But Ronan, thanks for coming on the line with me today.
Glad to be here, Kenneth. And I think we'll have a great discussion here today.
You know, I was looking back and I saw one of Ray Dalio's quotes that said, if you don't own gold, you know neither history nor economics. And, I know a lot of people believe, we have a lot of believers here in precious metals, and we've seen the price somewhat lag in certain aspects. Obviously, it's up from its low that we saw at the end of December of 2015, but it's kind of been lackluster lately. So I'd like to get your thoughts on what's going on in the precious metals market.
Yeah, as you say, the price has been really trading in a very tight trading range for much of last year, 2016. Between around $1,300 down to about $1,150, back up in the $1,200 range where it is right now. Like after Election Day in November, when Trump got elected, there was a very short-term bounce, but then about a 6-week downtrend until mid-December, and then it came back in the first few weeks of January up to February, and again it's in a very tight trading range. So I think that people shouldn't really look at the US dollar price of gold as the determining factor of why to own gold. Here at Bullion Star, we look at gold as a form of savings, and it's really the fact that people can buy physical precious metals, tangible wealth, and keep that for the long term. You can really look at gold as one of a number of things. Either it's a hedge or a safe haven, or else it's a form of saving, or it's a portfolio diversifier. So everyone has their own view on why they hold gold. But I think it's always a little bit dangerous to look at it just in terms of the US dollar price. I think personally it's better saying how many ounces of gold you have, how many ounces of silver, and just keep it in mind from a point of view that it's an alternative currency, and it's not really just a US dollar price financial asset.
Sure.
So I would say that the fact that the price is in such a tight trading range, it will have to break out of that triangular tight trading range at some point. And I think it's underpinned, the price, by the fact that there are real production costs for gold, and it can't really go that much lower. And the fact that in the geopolitical and the monetary risk sense, nothing has really changed since it made up its high back in 2011. In fact, things have got a lot worse. So it is a little bit puzzling as to why the price hasn't kept up with geopolitical events. And I think it's just a matter of when and not if that starts to happen again.
Yes, and I'm looking at a chart right now of the Dow to gold ratio, and historically right now at around 17. If you go back to any other time in history, this level, though we've been higher here and there, has guaranteed that we would go lower. The ratio would come down, and some are predicting that we'll go back down to 1-to-1, and basically it's a valuation metrics where the financials are getting overvalued and the sound money investment vehicles are undervalued. So I'd like to get your thoughts on that, and just get into the disconnect between the physical prices and the paper gold markets.
Yeah, like it's interesting. Ratios between different assets, be it gold silver ratio, Dow gold ratio, are always going to tell you something in terms of, is one thing overvalued or undervalued relative to the other. And even, for example, Bitcoin, because Bitcoin has now gone far past the gold price in US dollar terms. It was at 1-to-1 even a month ago, and now it's like 0.7 because Bitcoin is 1750, I think. Gold is like 1220. So these indicators will always tell you that really what they're capturing is just the momentum of one of the assets relative to the other. And with US stock markets hitting all new highs quite regularly in the last few months, it's going to, those type of ratios like the Dow gold ratio are going to indicate that really the way I look at it is that one set of financial assets are just more in vogue than the other at the moment. But again, the historical troughs and peaks are indicators that people will act psychologically in a different way when various, key ratios are hit. But getting back to your point where you mentioned about the paper market and the physical market, here at Bullion Star, we've always been keeping track of where the gold price actually comes from. Like even from the point of view of, we got a lot of charts on our website, and we talk to various information providers, market feed providers, data providers to try and get the best prices coming in globally 24 hours a day. And it made us start thinking about where the actual gold price comes from. So doing quite a bit of research, myself and some of the other people here at Bullion Star, we were reading even academic gold price research. Some of it is done by a professor called Brian Lucy, who's affiliated with the LBMA. And after reading some academic articles, we came to the conclusion that the gold price, according to their research, is formulated primarily in the markets that have the highest liquidity and highest trading volumes, which are, unfortunately, the London OTC gold market and the COMEX futures market in New York. So, like all financial markets, the markets that have the highest trading volumes invariably will dictate the prices at any given moment, as long as those markets are open. So if you take a step back and look at the London OTC gold market, it's really a wholesale gold market run by the big bullion banks, the investment banks that are operating out of London. And likewise, the COMEX market has the same big institutional players who are influencing a lot of pricing in those areas. And the volumes of these markets are phenomenal. And even someone who didn't really have a background in precious metals would have to look after a few minutes and realize that the volumes can't really be reflecting real physical gold that's trading, because there isn't enough physical gold in the world to reflect these huge trading volumes. Like the London market, trading volumes aren't published yet. They plan to do that possibly next year. But what they do publish at the moment are clearing volumes, which are netted trading volumes. And these clearing volumes, even by themselves, imply that there are something like 1.5 million tons of gold traded in London each year, or around 6,500 tons a day. And on the COMEX, there's about 180,000 tons of gold traded in the 100-ounce future every year, which is about 700 tons a day. But deliveries on COMEX are minimal, and likewise in the London market, deliveries of real physical metal are a minuscule percentage of total trading volume. So what you have is a situation where these huge casino-type venues in London and New York, which trade either synthetic gold, in the case of London, unallocated gold, and in the case of New York futures, they're determining the price for the physical markets around the world that just inherit that price. So it's quite an unusual situation that physical markets are price takers and the paper markets are the price makers. And it's really because of the huge growth of unallocated trading and futures trading.
Well, Ronan, would you say it's just a matter of dilution of the gold market? Because when someone wants to buy gold or trade gold, they do, but there's just so much diluted areas, too many areas to put the money because of these paper markets. They expand the contracts, and it doesn't reflect the physical, but it's diluting the physical market in that sense. Whereas if the paper market had some sort of implosion, that money would then go into the physical, and the physical price would be reflected. Could you kind of articulate that a little more for us, if you would?
Yeah, sure. I agree with what you're saying. In London, the way the market is structured is that it predominantly trades unallocated metal. Unallocated metal is really a claim that a holder has on a bullion bank. So I could go to a bullion bank and say, I want to get exposure to the gold price, which is what most institutional players and hedge funds want. So the bullion bank says to me, yes, here is your position in unallocated gold, but it really doesn't exist because the bullion bank could hold a certain amount of gold, but this unallocated claim is just saying that in some type of future scenario, the holder can go to the bullion bank and say, I have a claim on gold that you need to give me. But none of these positions and the trading of these positions ever settles physically. It's just cash settled. So they're really synthetic. It's really synthetic gold. And likewise in COMEX, even though the future contract has a mechanism for delivery, very few of the contracts ever go to full delivery. Like, for example, I think there was about 220 tons delivered last year in COMEX versus 180,000 tons traded. So the institutional players are happy to just trade these instruments because all they want is exposure to the gold price. So the existence of these particular products, like unallocated gold, really channels demand that otherwise would have gone into physical gold into paper gold. So that can continue as long as everybody's playing the game. It's like musical chairs, where there are very few chairs but a lot of people participating. But at the same time, you have the physical markets where there's a stock of gold above ground in the world, maybe 185,000 tons. Half of that is in jewelry. 30,000 tons possibly are in central bank reserves. Another 40,000 tons are in private hoards around the world, and another 20,000 might be used in industrial applications. But very little of that stock is currently accessible within the markets, or it's not being used. And then every year there's a flow of around 3,000 tons coming out from new mining. So then on the demand side, you've got nations like China and India pulling in huge amounts of gold, 2,500 tons of that new supply every year. So if this continues to happen, the only way that new extra supply will come on is through recycling, or else people bringing their existing stock of gold back into the market. And only higher prices will allow that new supply, that extra supply to come in. So if we think that there could be a price disconnect in the future when the paper traders realize that the physical gold market is quite tight and that the physical gold market demand is insatiable and is not going to stop. And if they realize that the price of physical might disconnect from the price of paper, what could happen is that the paper players will either try and convert their paper claims, but in a lot of cases, COMEX or London OTC might say that they can only be cash settled. Then they would try and sell their paper claims, which would make the price of gold, the international price of gold, would actually fall. But the physical markets would be dealing with a different situation, a lack of supply, where the price in physical markets would have to go a lot higher to meet the demand. So there could be a divergence. A point could be reached, an inflection point, at which time it could become a self-fulfilling prophecy that the paper price will plummet as the physical market price goes higher.
Ronan, let's talk about the Shanghai Gold Exchange. And many had predicted and talked about China sucking up the world's physical gold using this exchange and arbitrage taking place. And I'd like to get your thoughts on what has been taking place and, you know, what has been revealed to you in light of the Shanghai building in its popularity and some of the discrepancies that we're seeing between the different exchanges.
Yeah, China always takes a very long-term view on things, basically because it's a centrally planned economy. And back in the 1990s, the Chinese government, People's Republic of China, were even indicating in some of their 5-year plans that they wanted to liberalize the gold market. And one of the ways that they thought would be a good way to do this would be to create a gold exchange in Shanghai. So this was really planned back in the 90s. It opened up in 2002, and by 2004, anyone in China, like citizens, were able to trade on the Shanghai Gold Exchange, not just banks and institutional players. So there was a 10-year period between 2004 and 2014 when the Shanghai Gold Exchange was just expanding in popularity and in trading volumes. Then in 2014, in September, they introduced an international board. It's called the Shanghai International Gold Exchange, but it's actually just a segment of the existing exchange. So now there's an international board and a domestic board. And the international exchange allows international participants to trade both in a ring-fenced area using a vault in Shanghai that's in a free trade zone, and also they can trade on the main board. Now, the rules of gold importation and exportation in and out of China are quite strict. Only banks that have an import license can bring gold into the country, of which there's about 15 banks, 3 or 4 and 12 are Chinese banks. And there's very little gold allowed out of China. So it's not an open gold market, but what they are doing gradually is liberalizing it. So the advent of the international board has allowed international participants to start trading in that part of the market using the vault in the free trade zone, and also trading in the main board. And likewise, the domestic participants on the mainland board, so to speak, can trade in the international market, but they can't bring the gold out of the free trade zone into the other vaults. But what it does allow is price arbitrage between the gold price and also between the onshore and offshore yen. So the Chinese are just taking a long-term view of building up this physical gold exchange, which is the biggest physical gold exchange in the world. And last year they launched their own daily price fix, the Shanghai Gold Price Reference auction. That was in April of last year. So it's been going for about a year now. So this is just another aspect of the market that they've now got their own gold fix. So we think what's happening is that because they always play a long, patient game, they're creating the infrastructure and the environment to eventually take over price discovery from places like London OTC, the synthetic paper market, and to an extent take over price discovery from COMEX. So at the moment, the Shanghai Gold Exchange doesn't really influence the international price. Sometimes in China, because of the import restrictions, the premiums go higher than the international price. But there hasn't really been any feedback yet from the Shanghai Exchange to the international price. But that probably is only a matter of time, given the increasing importance and influence of Shanghai.
And so what exactly would be the triggering event, if you could speculate, or just kind of what would be the revelation to the rest of the market that China is more credible in their price discovery mechanism than what we currently use in London and the COMEX and these other large exchanges?
Well, it could be a case of premiums on the Chinese market going to quite large percentages over the international price. Or even it could be the People's Bank of China, the central bank, revealing that its gold holdings are far larger than they've said previously said they are. or else it could be some type of scandal on COMEX where it was revealed that contracts couldn't get settled through delivery, or else in the London market where it was revealed that the trading volume, the vault holdings in the Bank of England and in the commercial vaults were a lot lower than what people presumed they were.
Right. They'll take the delivery in those exchanges and take it to China where they can get a premium for their metal.
Yeah. Unfortunately, the large banks really have a foot in all of these markets, and the gold market is such an opaque market with lack of information on trading volumes. Apart from in China, perversely, China is very transparent on its trading volumes, whereas London is the opposite. So there was a development in the London market in the last few weeks, which is quite interesting, and that's to do with the Bank of England and the London Bullion Market Association, LBMA banks, have started to publish vault statistics on how much physical gold is actually in the Bank of England vault, and in a few months the LBMA will do likewise for the commercial vaults. And I think it's a case where they feel that to remain competitive to places like China, they have to become more transparent, that it's the competition from Asia that is really making them have to become more transparent, even though they don't really want to be.
Ronan, I'd like to get into central bank secrecy here, and there's many things about the system in general, the entire system, that just don't pass the smell test. And one of these things is central bank secrecy. And we know that, for instance, the Fed hasn't been audited in many years. Many question the gold holdings at Fort Knox. I want to go down the list here with you. You've revealed a lot of areas in which you've identified places where, hey, central banks are doing something behind the scenes here that don't pass the smell test. So take us down the line here.
Okay. Yeah, I've been with Bullion Star for the last 2.5 years. I've been writing a blog, and if anyone is interested in checking that out, the links will probably be on our segment here. And my colleague, Koos Janssen, also blogs about this Shanghai Gold Exchange and also about central banks, gold holdings, gold repatriation. So we have quite a lot of experience approaching central banks with questions, usually via email. Some of them are quite good at getting back to us, but invariably they're very secretive and they won't really reveal what we consider very easy information, very simple, basic requests. If you think about a central bank, they hold gold as part of their official reserve assets, and they hold it on their balance sheet along with foreign exchange, such as the dollar, the yen, the euro. But central banks have this get-out exemption that they negotiated with reporting authorities such as the IMF a long time ago, that when they publish their annual reports on their balance sheet, they consider gold that they hold and gold that they've lent or gold that they swapped to be the same item. So they put it in this catch-all category, gold and gold receivables. So any other company that did that would be in breach of international accounting regulations, because it's really saying the asset that I have and an asset that I don't really have, but I have a claim on it, are the same thing. So even though central banks in total might claim they have about 30,000 tons of gold in their official reserves, it's very hard to know whether that's actually true. They could have a lot less, but it's very difficult to know what they have because they don't have to break that down on the balance sheet between gold held and gold receivable. So that again is one of the areas that they're very secretive about. When you go to a central bank and ask, where is your gold, where it's held, it could be held in 2 or 3 different international locations. And only recently have some central banks got a little bit more transparent in that area. But as you said, no central bank that I know of gets their gold holdings independently audited. even their domestically held gold, let alone the gold that they claim to hold in the Bank of England or the Federal Reserve Board of New York, the Federal Reserve Bank of New York, sorry. And if you go to a central bank and ask them for a gold bar wait list, which some of our listeners would recognize from the Spider Gold Trust, for example, or the iShares Gold Trust. The Spider Gold Trust and the iShares Gold Trust every day publishes a gold bar wait list of all the bars that are held that is identifiable by unique serial numbers. These are the big gold, good delivery gold bars, which is the same as which central banks hold. But no central bank in the entire world has ever published a full wait list of the gold that it claims to hold. And I think one of the reasons they're so secretive about this area is that these central banks regularly engage in gold lending, gold swaps. They put their gold up as collateral for raising foreign exchange to use in intervention of currency support. And some of this gold goes out onto the market because bullion banks borrow it, and then they lend it on, and it can actually appear in gold ETFs. So I think there's been a huge coordinated plan by the central banks of the world never to allow a gold bar wait list go into the public domain, because that could start to allow people to say, oh, there's a gold bar that supposedly is held by a central bank, but is now appearing in a gold ETF. So they're just some of the areas where central banks are very secretive about. Another area is central bank gold is considered to be monetary gold because it's a monetary asset. And they've successfully been able to get an exemption from customs reporting. So if a central bank sends 100 tons of gold from London to Switzerland, that will never appear on trade statistics because it's been exempt from customs reporting. So everywhere you turn, central banks are operating in ultra secrecy in the gold market. Another connected area is within the London gold market, there is a huge, very active market in gold lending. So the gold lending market is a subset of the London gold market. But there's nothing at all about gold lending in the public domain. There is no information about volumes, outstanding positions, nothing. And the Bank of England will not reveal this, nor will any of the bullion banks, and nor will any of the central bank clients. So it's really a very secretive, opaque market. And it makes the market quite inefficient, because in a regular market, there are armies of analysts from buy-side firms and from hedge funds analyzing stocks and analyzing news flow. And actually the news flow and the analysis makes the markets efficient because the prices start reflecting available news flow. But in the gold market, central bank news flow is practically non-existent. So there's a case to be made where the gold price, even as is, isn't reflecting real trading activity in the central bank world or in the Bank of International Settlements gold trading desks in Basel, for example.
Yeah, no, that's a man. It's amazing what the extent they go to maintain and artificially support the system, and that's really what it is. They try to take the gold out of the monetary system, and that's what I'm hearing. That's what I'm hearing from you, and they're trying to keep a lid on it. And I'm curious, what are your thoughts on? You mentioned Bitcoin. Bitcoin's been on the market now. I mean, 2009, but now it's really becoming something that is in the news, and you see headline stories about it, and it's surpassed the price of gold. I'm just curious, is this a big concern for these central banks? Maybe not to the extent as gold is, but to the extent that they can't control it at this point, the way they do the gold price.
Yeah, I think it is. I think it's taken everybody unawares, the extent and the intensity of the accelerated price increases in Bitcoin. As a cryptocurrency, it is very useful, and with a lot of other cryptocurrencies out in the market, they're all competing to be for market share. And the fact that they are starting to be used, especially Bitcoin, proves that it is a viable technology. And a lot of people have researched it and concluded that, yes, it is a viable technology. I think the central banks, as you say, they are very scared about it. Central banks had always been, since gold, they tried to demonetize gold in the early 70s, late 70s. They look at gold as the way a vampire would look at the sun. They're terrified of it, but they sort of respect it at the same time. With Bitcoin, it's happened so quickly, and they can't control it because it's decentralized and it's in the cyber world, that they don't have Bitcoin reserves with which to dampen down the price, unlike the gold market where they do have gold reserves to release onto the market. I think the only thing that central banks might try and do would be to actually ramp up the price and make it crash, to try and dissuade people to get them out of the market. I have to say that I'm personally in awe of what's happening in Bitcoin, but at the same time, it feels a little bit like the late 90s, late 1999, early 2000 with the dot-com stocks, that even the fact that I'm getting to feel maybe I should put some money in Bitcoin, that might be an alarm bell that it's becoming too parabolic too fast.
Yeah, no, that's a good point right there. And I think everyone, that's in Bitcoin is glad to see it go up, but at the same time, looking at the charts going, well, I'm not sure how long this can go. Now, ultimately, I tend to think there's a long-term positive trend for more and more adopters of Bitcoin, and the infrastructure is building out, and especially as we see breakdowns and more fiat currency systems, more problems, people are going to look for alternatives. I mean, just what's going on in Venezuela and some of these other countries, people have used Bitcoin and are thankful that it existed for their situation. So Ronan, you bring up a lot of great points, and I just want to let you know that I'm very thankful that you came on the line, and you got a lot of knowledge. You gave me a lot of things to chew on, and I'm gonna actually go back and listen to this interview a couple more times here, take some notes, and just digest this information. So thank you for that. I want to give you an opportunity here to just share some closing words of advice for the audience, and just let everyone know about Bullion Star and what you guys offer.
Okay, great, Kenneth. Thank you. My pleasure being here. I think that in the last few years, I've become very interested in precious metals, and I think it's a really important area as part of people's wealth and portfolio management. My background was as an equity analyst, and a portfolio manager, and my academic background was actually studying finance and investment. So I look at things from a diversified perspective. And I think having been in the precious metals industry and also having been in the wider securities industry, I do think that precious metals is something that people should really consider as part of their portfolio, even if they look at it as a form of savings or as an investment. In Bullion Star, we specialize in providing physical precious metals to customers. That consists of gold bars, gold coins, silver bars, silver coins from the world's main mints and refineries. We also offer secure storage in our own vault, which is actually connected to the shop and showroom in Singapore. So customers can actually come into the shop, they can buy precious metals to take away, they can use our website online to buy precious metals for storage in the vault. They can actually use a bullion savings program where every month you can put a small amount of money into units of gold and silver, and when it reaches a certain level, you can convert that into physical bars and coins. So I think that it's going to be exciting in the next few years in the precious metals world. It's an area that I personally try and bring my training from the stock market world into the precious metals world, and I found that it is an area that's so opaque that it's actually a challenge and a nice challenge to try and find out more about it. So if you check out my blog, you'll see that a lot of the articles are trying to uncover information that no one else has previously touched on. So again, thanks, Kenneth.
Thank you so much, sir. We'll definitely